Okay, so we did get stocks opening higher earlier, but we ended up in the red. We're joined now for two blocks, which is great, by Noah Solomon, Chief Investment Officer at Outcome Metric Asset Management. Thanks so much for giving us the time.
Thanks very much for having me.
You saw the rally this morning. You weren't convinced. You think Trump will have to back down or at least slow his roll on the tariffs?
I do. So, if you go back a few days, basically until, when Trump made the announcement in the Rose Garden about, the escalation in tariffs and the trade war, obviously markets have reacted very badly, because of, fears of a global slowing recession, et cetera, escalation of trade wars. So not surprising there. This morning, you had a very strong bounce. Markets opened up very strong. But as you mentioned, I was skeptical for the simple reason that I am skeptical that markets will be able to muster any sustained rally until we get a clear change in direction out of the White House regarding trade policy and tariffs. So what we saw this morning was a technical bounce. It was not sustained. I suspect we will, if policy doesn't change, we will continue to get technical bounces here and there, but within the context of a declining market.
Maybe we could put up a one-week chart for the S&P 500, because last time I checked this afternoon, it was down about 10% in the past week. And so this morning, unfortunately, could have been a bit of a sucker rally, or at least over-optimistic anyway.
Yes.
Wow, we're down actually closer to 12% in the past week. The Mag 7 have been vulnerable. Those stocks were expensive. We're going to talk about the importance you attach to valuation. But do you see a decisive slowdown in AI spending?
I think it's too early to see whether we do or we don't. I wouldn't be surprised to see it because companies generally slow their capital expenditures and investment in what either is or they perceive will be a declining economic growth environment, which I think a lot of CEOs, if you kind of read the papers and read the comments, are very concerned about given the tariffs.
You say that it's nothing is universal, I know, in investing, but pretty reliably, when at the start of a period valuations are high, you got to watch out that you could well be in trouble. And we have come from some pretty high valuations.
So to your point, there's no question that, what's coming out of the White House, since Trump's Rose Garden announcements is what I like to call pouring salt in the wound. But to your point, there was a wound that preceded that. Valuations are very important. Now, I'll be clear, they're not important for predicting returns over the next month, 6 months, or a year. But as it turns out, when you look at the historical data, they're extremely valuable for predicting average returns over the next 5 to 10 years, over the medium to long term. Historically, almost without exception, whenever you've had valuations that were well above average, returns over the next 5 to 10 years are either far below average or negative. Conversely, almost without exception, whenever you started with far below average valuations, returns over the next 5 to 10 years have been far above average. So if you look at the S&P in particular, or U.S. stocks in particular, as of the end of last year, they started out in the 93rd percentile of their historical valuation range over the last 25 years.
The S&P 500
yes.
Broadly, not just the Mag 7.
The Mag 7 were, are a big part of that.
Part of it, of course. Yeah.
But the S&P 500 index, which, unless you think something is different, then that does not portend well for superb returns over the next 5 to 10 years.
The earnings yield, obviously important. We talk about the dividend yield, we talk about the multiple, but tell us about the importance you attach to the earnings yield on stocks.
So the earnings yield is basically the inverse of valuation, of PE. It's E over P. It's how many earnings you get on an annualized basis for every dollar you pay for stocks. And obviously, the higher the multiple, the lower the earnings yield, because it's the inverse. But you can look at that earnings yield and compare it to the yield on cash or high-quality bonds. And they call that spread the equity risk premium. And what it basically means, that spread, is the extra compensation from a valuation perspective that investors receive from leaving the safety of high-quality bonds and cash and taking their chances in the stock market. Now, historically, that difference between the earnings yield on stocks and the yield on high-grade bonds or cash has been 2 to 3%. The only time, so you get 2 to 3% extra pickup from a valuation perspective from leaving the safety of bonds and taking your chances in the stock market.
Yeah, that's what investors demand.
On average, historically, it's only been negative one time. It's gone the other way, and that was at the peak of the dot-com bubble. And we know how that ended with a particularly long, deep, and painful bear market. As of the end of last year, it was the second narrowest in recent history. It was basically zero, meaning investors are not getting any pickup from a valuation perspective for leaving the safety of high-grade bonds or cash and taking their chances in the stock market, meaning you're not getting compensated for risk.
And that points to euphoria, I suppose.
I wouldn't say markets are euphoric. Valuations were certainly nowhere near, but as I said, not as bad as in the late 90s, but certainly you're not being adequately compensated for taking risk. And, you know, when you look at Buffett, there's been a number of articles written on Buffett recently or over the last year saying he's built up record piles of cash. My guess is, and I can't read his mind, but my guess is he's saying valuations are quite elevated. They're in the precarious high end of the range, which again, historically has portended below average returns. And on the other side of the fence, I'm getting handsomely paid to wait. Unlike, you know, several years ago before interest rates went up, when interest rates were zero, you weren't well compensated for waiting. They call that, the acronym that was commonly used was TINA, T-I-N-A, which is there is no alternative. I'm getting nothing on my cash or bonds, so I'll be happy taking my chances in the stock market. Today, there is a viable alternative. So not only are you worried about stocks from a valuation perspective, but you're getting paid reasonably well to wait. So my guess is that's behind his thinking.
To wait by going into cash or into bonds.
High-grade bonds,
High-grade bonds. Maybe we can look at the US 10-year bond yield. And so you think compared to stocks, it's not a, I mean, it doesn't look like a lot of return to tie up your money for a decade, but you...
No, I didn't say for a decade. Because, you know, when I say average returns, when valuations are high, average returns over the next 5 to 10 years tend to be either below average or negative. But you can do this the easy way or the hard way. And what I mean by that is perhaps stocks, let's say, could not move much for 10 years, but earnings grow over time, so the multiple comes down. That's the benign adjustment. You could also have, like we're seeing now, a violent adjustment, in which case stocks could go down to the point where the earnings yield again looks good relative to bonds. It's a moving target. They could cut interest rates in response to a weak economy, and the spread could get even wider. Now you're getting compensated for taking risk. Valuations are what I like to think of as a buffer. So imagine the exact same development or adverse development in economic conditions, whether it's tariffs or inflation or some adverse, or unemployment goes up or a recession. The exact same adverse development can have very different effect on the stock market depending on your starting point in terms of valuations. So the analogy I like to use is like standing on the edge of a cliff. Imagine you're standing on the very edge of a cliff, on the very precipice looking over, and then a storm rolls in, a wind hits your back. Chances are if you're on the very precipice, you're done for. You're going over the cliff. Now imagine you're standing a few meters back from the edge of the cliff. The very same storm comes. Chances are you'll be able to brace yourself. Valuations are the same way. If you have an adverse economic shock, like the one we're seeing now because of tariffs, and you're starting at a high point in terms of valuations, the effect, as we've seen in the last week, is very severe and very quick. Imagine if valuations in the S&P were not 23 times. The PE was not 23 times. Imagine it was 15. I would be very confident saying that the very same announcement coming out of the White House would have had a far less severe impact on stocks because you're standing back from the edge of a cliff. And we've seen that. The S&P, which is far higher valued than other global markets, has suffered a worse decline than anywhere else.
It's down 15%
and to your point, within the S&P, the high multiple favorite Mag 7 stocks have suffered almost double the decline as their lower valuation counterparts because they're on the edge of the cliff.
Sorry, no, Will, I do love that metaphor.